One of the things I find interesting is how when people are given personal finance advice, they say that a mortgage is one of the best things you can do for yourself, that, and the third. And I actually find it very odd because I have a contrary opinion. And I genuinely think that a mortgage is not for everyone. In fact, I could say that a mortgage is a scam, especially if it's a mortgage for a property that you are going to be living in. Now, in this video, I'm going to break down all the reasons why I think that a mortgage is a scam. And I'm going to tell you all the truth that you need to know about a mortgage. Now, if that sounds like something you want to watch, then you should definitely keep on watching. Hi guys, my name is Oyinko, and if it's your first time stopping by, you, my darling, are most definitely welcome. Now, without further ado, please, I'd like to ask you to hit that subscribe button, like, share, and all that good stuff if you find this video interesting. And we're going to jump right into the nitty-gritty of the video. First things first, what is a mortgage? So a mortgage is basically a loan that you get from the bank because you want to buy a property. Typically, a mortgage is one of the lower interest loans that you can get in developed worlds. Sometimes mortgage rates are as low as 1.5%, 2%. Very recently, some mortgage rates have been going to 5% and 6%, but mortgage rates typically are quite low, and that is why many people do tend to encourage you to get a mortgage because it is a low interest debt. Now, why do people get mortgages? I know that many of us back home from Africa or even Asia are used to buying a property all at once when you have the cash, or building your property from scratch gradually till you're able to complete that property, however long it's going to take. But fortunately or unfortunately, in developed worlds like the UK, America, Canada, you would need a mortgage, which is basically a loan that the bank would give you. So say you want to buy a £300,000 property. Now, you go to the bank and you're like, hey, I want to buy this property. It's £300,000. First things first, the bank will check if you are eligible. It's like an affordability check. Can you afford this £300,000? And if they think you can, they would give you the money. Generally speaking, most people do tend to put about 10% of the property value as a deposit towards that property. So say the property is £300,000. Generally speaking, most people would put down £30,000 as a deposit, meaning that what they would actually collect from the bank is £270,000. Taking that £270,000 now from the bank is a loan, and the way that the bank is going to make money from you is to charge you interest for this loan that they are giving you. Many times people tend to take their mortgages for anywhere from 15 to 40 years, but most people tend to hover between 25 to 35 years. And the longer the term of your loan, the more interest you're going to pay. Is really that simple. So let's take, for example, this £300,000 house that we're talking about. You've put down £30,000 as a deposit, meaning that you now have £270,000 that you have borrowed from the bank. Now, you can put this in any mortgage calculator that you can find on the internet, but let's assume that the bank is charging you an interest rate of 4.5% for this £270,000 that they're giving you. And you want to take this mortgage for 30 years. Over 30 years, you're going to end up paying the bank back a total of over £490,000, with almost half of it being interest. So bearing in mind, you borrowed £270,000, but what you're actually going to end up paying back is an interest rate of over £222,000. This, of course, is assuming that the interest rate doesn't change over the entire 30 years of your mortgage, but many times the interest rate does tend to change. You may fix it for 5 years and it will change after that fixed time to become either lower or higher. And some people make arguments for remortgaging your property, meaning that after you've paid your mortgage for 5 years, you would have gained some form of equity, and you can go to another bank and say, hey, I have for example, 12% equity in this house. I'd like you to now loan me this and this amount of money. And then that could subsequently make your payments lower because you're going to pay back the initial bank that gave you money and you have now collected another mortgage from another bank. I don't know if that makes sense to you, but that is basically the way remortgaging works. There is also some argument for overpaying your mortgage, and there's an overpayment calculator on the internet. Still talking about this £300,000 loan that we've collected from the bank, assuming that you've decided that you want to overpay this loan now by £200 every month, you can significantly reduce the term of your mortgage from 30 years to just under 23 years, because overpaying by £200 regularly can take off a huge 6 years and 10 months off your mortgage, and can also save you almost £60,000 in interest. I'm saying all the pros of a mortgage because by the time I got to the cons, I want everyone to know that I am looking at the entire picture and I'm not just being biased. Now, the argument for people who say that a mortgage is an investment is that the property prices generally tend to appreciate every 10 years or so, meaning that if you bought your house at £300,000 today, in about 10 years, it could probably be worth £400,000, £450,000 thereabouts, all things being equal. But what they don't factor in is if something big happens around the time that you think you want to cash in on your house. So random example, another COVID type situation happens and nobody is really spending money because the whole world is in a panic, then your property would be worth less than it should be worth, and that means that you would not gain as much money as you think you would gain. Generally speaking, is when people talk about how much money they've gained over the property appreciating, they are not really factoring the interest costs that are associated with that property and the maintenance costs that are associated with that property. So now, for example, you've bought this property at £300,000 over 30 years and you have now paid back over £200,000 as interest. So this property is now worth, random example, £800,000 in 30 years when you want to sell it. This is just a random example. It's now worth £800,000. But you paid £300,000 for the property and you've paid an additional £220,000 as interest for this property, taking your initial cost price of this property from £300,000 to £520,000. Now, we've said that the property is worth £800,000. Over the 30 years that you've had this property, you have fixed the boiler that has broken, you have done a lot of renovation work in the property, you've done this and the third, and at the end of the day, the amount of money that you think you're gaining isn't really what you're gaining because you don't factor in the maintenance costs for the property, you don't factor in the renovation work that you've done, you don't factor in all these many things that you've had to buy for this property to keep it up to standard and to keep it up and running. So when people try to discourage people from renting houses and talk about, oh, the rent that you're paying, you're just pouring it away and you're not actually gaining any form of equity from it, I think renters actually do have pros. For example, some people want the flexibility that comes with renting. With a mortgage, you really can't decide that you want to wake up and leave the UK today. You would have to put some contingency plans in place. How are you going to sell your property? And I know that everyone says that this property is an asset, but truth be told, it's not a liquid asset, and it's not an asset that you can make liquid very quickly. It's not like the stock market that in a few days your money will be in your bank account. It does take months, sometimes years, to sell a property, depending on demand and supply, depending on the location of the property, depending on a lot of things really. So it's not an asset that is very liquid, and renters more often than not like the flexibility of just waking up and deciding that they don't want to be in this city anymore and bouncing, and that is very, very valid. Also, there's very little commitment with renting. You don't have to save up any deposit for renting. And I know that a mortgage is a low interest rate debt, but some people, now we've set £30,000 as the deposit, some people would rather put that £30,000 in an investment account like the stocks and shares ISA that tracks the S&P 500. And generally speaking, that has done an average of 10% per annum in the past few years. So that means that if you do that, you would more often than not generate higher returns than the quote and unquote mortgage interest rates. Another pro with renting, obviously, is the fact that if something breaks down in the house, it's not really your problem. So, for example, the boiler stops working, all you have to do is pick up your phone and call the landlord and you're like, hey, the boiler is not working, can you come fix it? But if it's your property, then that's your responsibility. Another con, of course, with a mortgage is the fact that your interest rates can't change. Now, you've had this property for X amount of years and you've been paying X amount of money, but after this term has expired and it's time to remortgage, your interest rates could actually go up, and that can significantly affect the amount of money that you're making as payments monthly. Also, if you don't keep up with your monthly payments, your house could be repossessed, and that means that the initial deposit that you put into that house is gone, and every single payment that you've made towards that property is also gone. Also, the fact that in the initial periods of your mortgage, you are actually paying mostly the interest and very little actually goes into the principal. So many times when people say, oh, I'm going to resell this house after 5 years and I would have gained some equity, that is true. You would have gained some equity, but the amount of equity that you'd have gained usually is quite little because you have been paying mostly the interest that you have accumulated as a result of this borrowing that you've done. Now, what are the types of mortgages that exist? There are two primary types of mortgages. There's an interest-only mortgage and there's a repayment mortgage. As the name implies, with an interest-only mortgage, you are primarily paying only the interest. So we've talked about £270,000 loan from the bank. You are going to generate some interest for this 30-year term that you've decided to take the mortgage. And that means that all the payments that you're making would be geared towards paying back only the interest and you're not paying back the principal. What does this mean for you? It means that at the end of the 30 years, you have to pay the bank back their money by either selling the house and giving them their £270,000 back, or they collecting the £270 back from you. Just one way or the other, that £270,000 has to come. Versus a repayment mortgage, which is you paying the interest and the principal. But you start off paying the interest heavily for the initial periods of the mortgage, and then you start to pay the principal towards the tail end of the mortgage. At the end of the day, really, there's no right or wrong answer, and it really does depend on you. Personally speaking, and this is just my own opinion, and this again is a disclaimer, this is not any form of personal finance advice. I'm just sharing my opinion on this matter, and it's up to you to make an informed decision for whatever works best for you. Generally speaking, I believe that a mortgage is not an investment for myself. It is an investment for sure for my children or for my grandchildren, but for myself, it is not an investment. On S&P 500, the stocks and shares market, starting a business is a better investment that yields better ROI for myself. But in terms of leaving something for your children, then I would say a mortgage is a good investment, because in your lifetime, for that house that you have bought for you to live in, you're going to end up pouring a lot of money into that house. And at the end of the day, it might even be a liability in the same light that a car is a liability. Now, are we going to say that a car is not necessary because it's a liability? No. For most people, a car is a necessity. Whether or not it's a liability is another kettle of fish. That is the exact same way that I view a mortgage that you live in. It's a liability, But is it a liability that is necessary? 100%, especially if you would like to hand something over down to your children. So is a mortgage an investment? I think it's an investment of some sort, but is it an investment for you? Probably not. It's an investment that your children and your grandchildren would benefit a whole lot more than you would benefit from. Anyways, that is my 2 cents on a mortgage and whether it's a scam or not. What do you think about this? Do you think a mortgage is a scam? Are you happy to rent? I really want to know what your thoughts are down in the comment section. Thank you guys so much for watching. If you did enjoy this video, please don't forget to like, share, subscribe, and all that good stuff. And I will catch you in my next video.